A wise man once said, what goes up must come down. And in the case of interest rates, what goes down must eventually come back up, especially with the economies and central banks around the world facing record levels of inflation. The Reserve Bank of Australia is really stuck between a rock and a hard place. If you have been supporting my channel for a while, then you will know my position on interest rates, and my stance has always been that we will see higher interest rates before 2024. In today's video, I will explain to you why I personally think we will see higher interest rates sooner rather than later. And I will also explain to you why I think the central banks around the world have no choice but to lift interest rates very soon, as well as how this will affect the Australian housing market going forward, what we should expect, and how we can prepare ourselves for what's ahead. This video is going to be packed full of useful information, so make sure you guys watch it till the very end so you don't miss anything. And as always, please understand that this is not financial advice and I am not a financial advisor. I am simply sharing with you guys my personal opinions and strategies, and I will always recommend you guys to do your own research and due diligence before investing any amount of money into the real estate market. Let's get straight into the video and talk about interest rates. It's very easy for me to sit here and say interest rates will go up, but I think what's more important is for you to understand why. Instead of looking at interest rates as a number that just goes up or down depending on the government and central bank's mood, let's look at it as a function that the Reserve Bank of Australia uses to control economic activity. The interest rate is used to determine how much interest is paid when someone borrows money. So naturally, when the interest rate is higher, less people will borrow money and they will be able to borrow less money. And this will mean there will be less economic activity because people are spending less money. So from the central banks and the government's point of view, whenever they want to increase the level of economic activity, all they have to do is reduce interest rates. And this is going to lead to lower cost of borrowing, which will in turn encourage more and more people to borrow money and then spend that money in either the housing market or the economy, which is good for everyone. So if this is the case, why doesn't the Australian government and the Reserve Bank of Australia just keep dropping interest rates so we can have a speedy recovery from this once-in-a-lifetime pandemic? Well, they already have, and with the interest rate sitting at pretty much zero, it leaves us in a very dangerous situation, because if we were to suddenly face another economic shock like what we have just witnessed and experienced, the government and the Reserve Bank of Australia will have no more ammunition to lower rates further because the rates are already at zero. So it will be very hard for them to stimulate the economy again when something bad happens. Another thing to consider is that when the central bank reduces the interest rates, they are in the process printing a shitload of money. And this is going to lead to high levels of inflation because more money is being added to the money supply. And from 2020 until now, this is exactly what we have seen. The governments in Australia and around the world have printed a crap load of money, and that has been added to the money supply to help the housing markets, the economic recovery, as well as struggling businesses. And what we have seen from then until now is that pretty much all asset classes, real estate, the stock market, and pretty much anything that people can invest in has shot up in price. The reason for this is that when there's so much more money being added to the money supply, our money becomes less valuable as it becomes more and more diluted. Just think of it as adding Coke to your bourbon. When we add a small amount of Coke, it is very hard for us to notice the difference. But when we add a big amount, it is very easy to notice that the bourbon has become less and less strong and we'll have to drink a lot more of it to get drunk. When we add so much money to the money supply, it increases the price of goods and services. And this is exactly what we have seen over the last 2 years. The price of everything we need to maintain our quality of life has increased dramatically. And this is where we find ourselves. The Reserve Bank of Australia has printed way too much money over the last 2 years and created way too much inflation, and people are losing their purchasing power very rapidly. Just think about it. The price of housing has increased by more than 20% over the last 12 months. This is an essential part of our survival. Everybody needs housing. And the same thing can be said for just about everything else that we need to maintain our quality of life, such as groceries, petrol, entertainment, and anything that we can spend money on. All of those have increased dramatically. Inflation itself is a normal function of the economic machine. However, high inflation is very dangerous because it creates massive bubbles and it is unsustainable. And these bubbles could burst at any time whenever we face our next economic shock. especially when the Reserve Bank of Australia can't simply just lower interest rates again to stimulate the economy because interest rates are already at zero. I think the government and the Reserve Bank of Australia realize this, and they understand that if they let the property market run hot like it has been, it's going to lead to some very serious issues later down the track. So instead of lifting interest rates in 2024 as they originally promised, I think we could see higher interest rates as early as 2022. Just imagine what will happen if the government doesn't do anything to control this market and we see the same amount of growth for the next 2 years. We will see the median house price in Sydney go to more than $2 million. If that's not a bubble, then I don't know what is. Another thing that we need to understand is that there is an election coming up, and creating a massive property bubble that is unaffordable to a majority of Australians is not going to be a popular policy. And I think the government realizes this, and in the next few months and years, we are going to see them change their approach to tackle these runaway house prices. I already know what some of you guys are saying, and that is the argument that they can't increase interest rates because Melbourne and Sydney are still recovering from their most recent lockdowns. Well, it doesn't really matter if they increase the interest rates or not, because the banks have already started increasing their long-term fixed rates. As we can see here, most of our major banks are factoring in these earlier than expected rate rises and inflationary pressures, and have increased their long-term fixed rates by a noticeable amount, with CBA increasing their 5-year fixed rate by 0.1% and 0.5% for 4-year fixed terms. Westpac has also increased their fixed rate by between 0.1% for 4 and 5-year fixed rates and by 0.21% for loans with a 3-year fixed term. NAB increased its fixed rate by 0.1% for all terms except for 1 year and 4 years, and increased the 5-year fixed rate by 0.2%. If you listened to my previous videos that I posted a few months ago, warning you guys about this earlier than expected rate rises and locked in your rates at much lower rates, congratulations, you have just saved thousands of dollars, if not tens of thousands of dollars. Higher interest rates is no longer an argument or a theory, it is already here. Our banks are already increasing their interest rates, and a lot of us are already starting to pay these higher rates. So let's now talk about what this will mean for the property market. As we talked about before, higher interest rates is bad for investing in general because the cost of borrowing money to invest has increased dramatically, which will lead to less borrowing. Higher interest rates will also mean people can now borrow less money, because higher interest rates leads to higher repayments. Look, what I'm about to say next is probably not what you want to hear. And whenever I say this, I get a bunch of dislikes on this video. But that's okay, because one thing that I can promise you is that I will always be honest with you guys. With interest rates increasing and borrowing capacity decreasing, what do you think is going to happen to the markets where people are already maxed out and they had to max out their borrowing capacity just to get into the market? The people who took up these massive loans to get into the market are now facing much higher repayments, and the people who are trying to get into the market can now borrow a lot less money. So naturally, the growth in those markets is likely to slow down. Look, I completely understand the argument that investors are cashed up, both local and overseas investors, and that's true. They do have a lot of equity and cash built up from their previous investments. However, one thing that we should understand is that while investors have a strong influence on the market, they do not dictate the entire property market. In fact, if we look at this graph here, which shows the amount of home loan commitments, it would be fair to say that owner-occupiers have a much higher influence on the property market. This data is a bit outdated and investors have come back into the market in a big way. But this just goes to show that owner-occupiers and first-home buyers have a massive influence on the market, probably even a controlling influence on the market. Now, circling back, I personally believe higher interest rates, higher repayments, and reduced borrowing capacities will have a big impact on the Melbourne and Sydney property markets. Because let's be honest, housing in Melbourne and Sydney is already very unaffordable. And if interest rates were to start rising from here, I think this will put the housing market completely out of reach for a lot of people in Melbourne and Sydney. Look, I know there are a lot of factors driving growth in Melbourne and Sydney, such as high-paying jobs and strong population growth. But the truth is, if people want to buy property and there's a lot of demand for property, but if they can't afford it, there's no way they can get into the market. It's just as simple as that. We can have huge demand on one hand and a massive shortage of housing on the other. But if people can't afford to borrow enough money to get into the markets, or they can't afford to service their mortgages at higher interest rates, there's simply not going to be much growth. Does this mean the housing market is doomed? Is this the end of our housing boom? I personally don't think so. I'm actually quite bullish on the property market over the next few years, just not Melbourne and Sydney property markets. What we need to understand is that while some of our markets are extremely unaffordable and over-leveraged in my opinion, there are still markets where affordability is not an issue, meaning an increase in interest rates is likely to have little to no effect. Look, I know you guys are probably sick of listening to me just share my personal opinion, so let's take a look back at history. If we think about what's happening right now, it is very similar to what happened back in 2017, when the government stepped on the brakes to try to slow down the unsustainable housing boom. So what happened back in 2017? Well, the first step was introducing APRA, which is exactly what happened last month when APRA was brought back in to regulate the banks and imposed tough lending practices. And if you're in the finance industry or trying to secure a loan, then you know how hard it has become over the last few months to get a loan. Some of the people I talk to tell me that prices in Melbourne and Sydney simply cannot fall because that's our biggest markets. And I simply do not agree with that, and let me show you why. Going back to 2018, we can see that house prices in Sydney and Melbourne can indeed fall, and it fell by a massive 7.4% in Sydney and a 4.7% in Melbourne, while markets like Canberra, Hobart, Adelaide and Brisbane recorded good growth, with Hobart recording a growth of almost 10%. Looking at Sydney and Melbourne, what do these two markets have in common? Well, these two markets have serious affordability issues. They are more susceptible to higher interest rates. And if we look at markets like Canberra, Hobart, Adelaide and Brisbane, what did these markets have in common? Well, first of all, affordability was not an issue in these markets, and people didn't have to cripple themselves with a lot of debt just to step into these markets. Look, I'm not telling you guys that Melbourne and Sydney is doomed, because if I do, you guys will give me a lot of dislikes and I don't want that. But to be honest with you guys, I'm still quite bullish on these markets over the long term. But based on the current economic factors, I personally do not think Melbourne and Sydney are good investments. I know what you guys are about to ask, and you guys probably know what I'm about to say. And your question is, where is a good opportunity? Where can I now invest my money to get good returns in the property market? Well, if you follow me on my Instagram at Invest with Zeng, then you will know exactly where I've been buying for myself and for my clients. And that's in the more affordable markets where housing affordability is not an issue. These markets also have very strong cash flow, which is going to be very important in the next few years as interest rates start to rise and rise, and as more investors try to get cash flow generating properties, and as mortgage repayments start to increase. So what's my favorite market right now? Well, instead of me giving you all the answers, I want you to do your own research. But don't worry, I'll give you a few hints. The market that I like the most right now has the lowest unemployment rate in Australia. It also has the strongest economic growth in the entire country. The economic growth in the state is actually up a staggering 30% from the decade average. And that's real economic growth, not growth propped up by a booming housing market because of all the cheap debt the government is giving out. I'm talking about an economy where real jobs are being created and people are getting solid pay rises that keep up with inflation, and where the economic growth is so strong that it is leading the country into a speedy recovery. If you guys know which markets I'm talking about, and most of you guys probably do, leave a comment below so that other viewers know. Again, all of this is just my personal opinion, and I could definitely be wrong, and I have been wrong many times before. So make sure you guys do your own research into this, okay? Don't just listen to me on this. I want you guys to look at the data, to look at the numbers, and look at the different markets as well as the market activities that's happening in each of these markets we just discussed. Because after all, I'm just some guy that you found on the internet, and the internet can be a very dangerous place. And you have no idea if any of this information that I'm giving you is verified or even true. Alright guys, I want to thank you guys for watching this video to the very end, and I really appreciate all of your support on this channel. And if you did get some value out of this video or learn something new, please return the favor by hitting that like button right there and commenting your thoughts. If you don't already, go follow me on Instagram where I post daily. Hope you guys have a lovely week ahead, and I'll see all of you guys in the next video.